Hello and welcome to The View from IMF. Today I'm joined by Janet Henry, Global Chief Economist at HSBC. Janet, thank you so much for joining us.
Hi.
So first off, today actually we're exactly 1 month away from the US presidential elections. Many economists suggest that if we were to see Trump win, because of the policies he's pushing for and because he's been quite vocal about saying that rates have been too low for too long, it is quite likely that we might see a Fed rate hike in the near future. Whereas if we were to have a Clinton win scenario, maybe we might see more of the status quo in terms of Fed rates. Do you agree with that analysis?
I think that's simplifying it a little bit. I think the Fed's been very clear and has shown by its reaction over the course of the last year that they are responding to the data. And as we now know, that means all the data. It means what's happening in the US labour market, what's happening in US inflation, what's happening in terms of global financial markets. So there are a lot of factors driving it. So in the very short term, not least December, a lot will really depend on what happens to the data over the course of the next few months, and particularly what happens to wage growth. So I don't think there's going to be an immediate impact on the Fed's rate decision in December, depending on what happens from the US presidential elections. And then I suspect, they will continue over the coming year to lower their expectations for the medium-term rate outlook, but it will then depend on what policies are implemented, whether there is a Trump or a Clinton presidency, whether there is then an implementation of some of the trade protectionism measures that have been committed to by Donald Trump, what gets through Parliament and what kind of fiscal stimulus. So I suspect the Fed won't react to what they expect to happen on policy, but by what is actually delivered in the coming year.
Yes, and I believe, I think probably this kind of analysis when it comes to a potential Trump scenario is exactly based on what might happen to the data if immigration actually does drop and wages start growing, or if there is more of an import substitution mindset, or a bigger fiscal stimulus with higher taxes that might have inflationary pressures. And I guess at that stage, the data might suggest or give signals to the Fed that in some case it might have to increase rates.
Absolutely, and of course, the extent to which all of those policies impact on what's happening elsewhere in the world will then feed back into the US. And certainly a big part of what's happening in the world, and certainly part of our view at HSBC, is that the kind of global disinflationary pressures will still mean that US inflation remains relatively low, and that's probably still likely to be the primary driver of keeping US rates rising only very, very gradually over the course of the next year or two.
And when we talk about global consequences and effects, if there were to be a Fed rate increase in the near future, what do you think that might mean for the Asian region, especially in terms of responses to that policy on the monetary level, but also in light of potential credit crunch that we're seeing in the private sector with very high corporate debt and some of the financial systems being under strain because of this increase in non-performing assets?
Well, I think when the Fed raises interest rates, it's very unlikely when the next rise will come as a surprise. Maybe it's December, maybe it's March, maybe it even comes a little bit later, which is what our US economists are actually forecasting. But I suspect they won't raise rates until the market has already priced it in. And also then it will be what they signal in terms of the extent of future rate rises thereafter. And then of course the markets will react. But of course, a lot depends on how policymakers elsewhere in the world react. Do we see surprises in terms of rate cuts or rate rises elsewhere in the world? That certainly was what happened in January of this year. It was the emerging market turmoil that came through partly in response to policy decisions that were taken that delivered the surprises.
Drops, yes.
It wasn't the Fed rate rises at all. But your point about Asia, we are already seeing corporate lending growth slow down in Asia. There are some supply reasons, there are some demand reasons, and household lending has remained a little bit more supportive. But actually our Asian economists talk about the whole concept of debt saturation in Asia, and we don't have a strong revival in growth, but we still have some stabilisation in growth, just driven by debt to a lesser extent than it actually has been. But it's not just a supply constraint, as I think you're suggesting. Actually, indebtedness is quite high, and the demand to take on new debt has already started to fade.
Yes. Yeah. When we look more on the European angle, of course, just yesterday, October 7th, we saw the sterling drop 6% on the back also of statements made by Theresa May in terms of the kind of Brexit scenario she is going for. It seems that she is going more for a hard Brexit, and the drop in currency, and also in the FT today we saw a piece saying that UK corporate heads have written a letter suggesting that going for a hard Brexit might be very damaging for the corporate sector in the UK. Do you think that this big move in the currency and what has happened so far and what you've been analysing shows that actually, yes, there is a big worry that if a hard Brexit is pursued, the market will suffer?
Well, I think what we've seen since the Brexit vote was, in many ways, less of a market reaction than many had feared, because there seemed to be this suggestion that the Brexit would perhaps not even happen, or if it did happen, it would be very, very minor in terms of the impact. It'd be very, very gentle kind of Brexit. So obviously what we had at the start of the week was the indication by the new UK Prime Minister that actually it was more likely to be of a harder variety, because the need to restrict immigration meant that we would have to have a harder type of exit. So that's the kind of signal that we've been given. Obviously, what's happened with the currency slide was affected by the lack of market liquidity, but I think the direction is quite clear. A weaker sterling is part of the adjustment, and it's reflecting ongoing uncertainty about near-term growth and indeed medium-term growth. What happens against an environment where you don't necessarily have such a dramatic free flow of labour actually starting to come through. But remember, the whole nature of negotiation is that the direction can change over time, and some of the pressures that you're suggesting and the reality of the situation may mean that it's not just one single direction, and that's something that markets will respond to over time, as indeed will companies. It's all adding to the investor uncertainty.
And in terms of one of the points that firms are most worried about is that if the hard line on immigration is followed, it seems as of now, in terms of the reaction from Europe, that the possibility of remaining into the common market is very, very slim. Is this a fair analysis to make? And it doesn't mean that in terms of, from the corporate point of view, there might have to be some negotiations made also on the immigration front if the access to the common market has to be sustained?
I think there's going to be discussions about all of this. Obviously, there's going to be negotiations, and the signal from Europe is that there won't be any firm negotiations until Article 50 has been invoked. But when we think about the corporate sector, obviously their willingness to invest will depend on which parts of the single market we have access to, whether we have some kind of customs union, and all of that affects supply chains across Europe. It can affect trading relationships. It can affect, and the UK's manufacturing sector gets a lot of its imported components from Europe. If you know there's going to be some element of tariffs or non-tariff barriers coming through, that will affect economic activity, and again exacerbate this tendency to refrain from investment spending.
Well, thank you very much, Janet, for your time, and do enjoy the IMF meetings. Thank you.
Thank you very much.
Thanks.